I can't remember, but it was way back over here. Yeah, it was this trade here. So what had happened to the intern was this situation here. So this is the intern's view at this stage, and I've left the arrows on the screens. And it's an important lesson, I suppose. So it's not really, I shouldn't really do it at this time of the day because people will be busy and not paying any attention. But the basic idea of it is context. There was a miss on the context of the macro. There was a miss on the context of the macro value, the macro levels. The short-term value was good. I mean, the short-term value was good, but there was this idea of losing sight of everything else that was going on in the background because they hadn't looked away from that chart for 2 or 3 hours. So for 2 or 3 hours, they hadn't got back to the context of the charts. I'll leave these arrows on the screen to remind me to do this in classroom today. And that's obviously something that, because it was incredibly important, because what they did was they sold here and they started to look at that and say, that was a great trade. They recognized that I was buying into this trade and they were like, I don't understand why I'm selling at the higher price, but you're still buying into this area. What's going on? And obviously what happened was that the price then broke north and they lost 4 ticks on the deal. They lost 4 ticks on the deal. Okay, so you only lost 4 ticks. That's okay. I'm happy with that. But it was a mistake to be in it in the first place. We'll obviously touch on that mistake in classroom because learning from that mistake is quite an important learning point for anybody to understand in terms of the idea of macros. Very important that we get round to just paying attention to those elements. The other thing that you'd obviously have been aware of is what price we're at the moment on the SPY. Yet again, it's opened almost in exactly the same place as yesterday's market opened, right on one of the key dealer levels. This time it's the inside dealer level. It's the puts level. So the dealer does have the opportunity to hedge their put exposure if they want to. So if the dealer has the opportunity to hedge their put exposure if they want to, then this is a critical price print to get right, because if the price starts selling off, they lose money on every single put option they sold into yesterday's close because they haven't priced volatility high enough. So they'll lose money if the price breaks south out of here. They won't lose money net because their net position is obviously the break of the bottom edge, their whole entire position, the net of the calls and the puts. You may say, well, that's the gross position, whatever you want to call it. But you get the basic idea. It's an incredibly important price level. They're getting to keep all the call premiums, which is fairly substantial. 23 points is a pretty substantial premium to keep. But obviously they're about to start paying out on their puts, which means by the time they reach the bottom line, they've paid out all the profit they would have had from the calls. They've paid all of that money out if they don't hedge. So they've got a big decision to make here. Do they hedge by selling stocks? Or do they try and defend the level by buying stocks back to the maximum gain level? That's the decision that the dealers have to make right now. And what are they going to do to make that decision? They're going to check their value. They're going to check to see whether the pressure's coming in on the buy side or the sell side. And they're going to try and come up with a trade here. They're going to try and come up with an idea. Well, you can see what happened here. You can see what happened at the very top edge when we took our profits. That was a pretty good profit take, right? We saw the auction slowing down into the top edge. We took our money as soon as we seen that top line forming, we took our money. Look at that sell, guys. It came in after we took our profits. That was a live room call. We top ticked the S&P live in the room, guys. Very few people will be able to do that, wouldn't they? But you can see why we top ticked it, because number one, the level was something we talked about this morning. Number two, the value diverged against the red line right there. So the basic requirement for a sell was actually met at that point. As we come back into the bottom edges, of course, we start watching the story. The dealers are making decisions all the way through this, and I can see at the bottom edge this time, the bubble is not forming in our favor just yet. So there's obviously now this idea that they're going to go for swing lows. Well, we can see the swing lows down here. We can see where the squeeze is going to take place. It's going to be 40.70s. The value suggests that we should sell 40.70s, and guess what? It's just went through 40.70s. No shit, Sherlock. Shit, Sherlock, indeed. Crazy, right?